joining us today. Well, looks like the festive cheer is coming to the market now, but the key question is, are we going to be able to hold on to these levels, and where next do you see the markets headed from here on?
I definitely think these gains will be held on to simply because over the last 2 months, we have not only seen performance in particular stocks and sectors far better than the Nifty itself. The Nifty is essentially been bogged down by news flow around different parts of the tariff regime. But I think every part of it now has been addressed, whether it's IT, pharma, hospitality, you name it, media. So if everything has already been addressed, it is sort of discounted in the market. So therefore, I don't think there's any more negative flow going to come from that front, and that is where the market start discounting what lies ahead. And I think what lies ahead is a steady improvement in the earning situation from here on. The initial one actually coming on the back of the boost that is coming from government measures, whether it's GST, whether it's tax cuts, all of that coming together, and interest rate cuts. And eventually that would continue on the basis of the inertia or the momentum that we end up developing because of all this. Now, technically, it creating a good situation for us especially as we break past 25,200 is a level, or 220 was a level where we had stopped at least 3 to 4 times in the past. So if we are able to close above that today, that is an initial positive sign. I know we did that in September as well and then fell back, but we did not fall to a lower low compared to where we were in August. So in that sense, broadly, the market is making slightly higher bottoms, and getting past this level will be an additional sign that the positive momentum is picking up. The last one we'll probably watch out for will be how it does on the weekly closing, because our weekly momentum indicators may also trigger buy signals. It's already done that for the Bank Nifty last weekend, and we are watching out whether it does that for the Nifty as well by this weekend. If the weekly Nifty remains positive on a week-on-week basis, we are most likely to get that signal.
Understood. So that's about, on the weekly basis. But for the short term, Rohit, would you like to give any targets for the Nifty and Nifty Bank?
So I think around 25,680 initially, and then probably to retest the high of 26,300.
Let's see when we, test that high of 26,300 again. But, speaking of sectors, lots of IT earnings are out already, especially large caps. For instance, Tech Mahindra we had yesterday. It's reported a steady set, but still the stock is pretty muted today. So going forward for the IT pack in the short term, what do you see? So earnings momentum is, gradually picking up, better than expected earnings for most counters so far. So what's the outlook for the IT sector there?
So there are three parts of the market that I would avoid from an investment perspective, and these three parts of the market are essentially the defensive parts of the market, which is IT, FMCG, and pharma. Some people might find it surprising that I put IT in the defensive space, but then for a sector whose earnings are growing in single digits, especially for the large caps, we would call them defensive. You only buy single digit earnings growth when there's no earnings growth in the market, and that's not the case. So which simply means that if you're looking at beating the Nifty, then the IT sector is not the place where you're going to be. In fact, on a 30-year basis, the IT index has underperformed the Nifty. So basically, it's not the place to be for large caps. Only if you can find an individual IT stock showing a surge of growth due to some reason, you might want to participate there. But broadly, on a large cap IT basis, uh, the IT sector should be avoided from a performance perspective if you're really looking at even doing Nifty rate of returns. Okay, so that's the defensive part. So we do away with that and essentially end up focusing on areas where there is growth. That will include a bit of financials, autos, some of the interest rate sensitives from metals to what you're seeing today is a run up in realty stocks. So these are the places where I think you're likely to see a pickup in growth initially, and it may spread to other growth segments also, from power to infra. So that's where you want your money to be and not in the defensive space.
Okay, so those are some stock and sector specific ideas coming in, Mr. Srivastava. Thank you so much for taking your